Remember Deutsche Bank chairman Lord Aldington and CDO squared? He was the bank boss who embarrassed himself before the Treasury Select Committee in 2008 when he couldn't explain one of the products at the heart of the financial crisis.
ETFs and ETPs were created to capture investors' market volatility index, or the VIX. Credit Suisse rocket scientists created the VIX spelled backwards, which moves in the opposite direction to the volatility index. The Swiss casino bank unsettled markets when it closed the fund this week after it tumbled 80%. If only it were so simple. The difficulty is that the sophisticates in the trading rooms of Wall Street and the city, and the sole traders operating out of darkened rooms in Miami and Hounslow, spend very little real money buying into such funds. Much of the trade is done on leverage, borrowings, and the deals are insured by derivatives, trades in futures and options. Such transactions are far away from the fundamentals of turnover, earnings and dividends, with an overlay of broader economic sentiment, which are the real engines of the Dow Jones, the FTSE 100 and other global equities. When sentiment shifted at the end of January, with the perception that interest rates may rise more speedily and higher than predicted, Wall Street, with justification, reacted out of fear. If only a small percentage of these trades were highly leveraged and it all went very wrong, there could be big credit risks for the banks.
The other potential banana skin arising from the sudden falls in stock markets, particularly if the correction turns to a rout, is that as the equity tide goes out it leaves on the seashore those companies, Carillion is a classic, carrying too much debt on their balance sheets. The IMF's 2017 Financial Stability Report calculates that, since the financial crisis, non-financial borrowing has soared to $135 trillion, £96.4 trillion, or 235% of total output among the G20 leading economies. As interest rates rise, so will debt service costs and credit risk could take off.